Hi, I'm Pattu from freefincal. Today, let's take a look at Motilal Oswal's new index fund, the MSCI EAFE Top 100 Select Index Fund. That's a mouthful. So, this is a world index that excludes stocks from US and Canada. The fund is in its NFO period. So it has got stocks from 21 developed countries excluding the US and Canada. So EAFE refers to Europe, Australasia and the Far East. It has got the mother index has got, that is the MSCI EAFE index, has got 843 stocks, and out of that the MSCI EAFE top 100 index select index has got 100 stocks from the top 10 countries by weight, and each country has got a maximum weight cap of about 40%. I could not find any data on the top 100 index. My guess is it's probably a specialized index custom made for the AMC, Motilal Oswal. But since it is market cap weighted, we can look at the parent index, the MSCI EAFE, and that will give you a reasonable idea. Now, to understand how stocks have behaved since the 2008 crash, you can see here, this is a screenshot from the MSCI EAFE fact sheet. Now the EAFE index is the blue one, which is at the bottom. You can see this one. The world index is the yellow line, and the cyan line is the MSCI ACWI. ACWI is another world index. I forget what ACWI is, but the world index, I think, has got about, at least in the last few years, it is heavily dominated by US stocks, and that's got about 60-70% of US stocks at any given time. So you can see how since the 2008 crash, the recovery after that, the US stocks have dominated the the international stock lists, and you can see that any index that has got exposure to US stocks has done well, and the EAFE index has not done well relatively. Now, most people who say that they want international diversification do so only because they have looked at the returns of either the Nasdaq 100 or the S&P 500. They have looked at the returns of the US stocks, especially the tech giants, and they want a slice of that. To justify their actions, they tell everybody, particularly to themselves, that they are diversifying their portfolio. They are looking for geographical diversification and so on. Now, okay, this EAFE index will give you geographical diversification without US and Canada. How many people will want that? If you look at the 10-year rolling returns of the EAFE index, that's the green line, compare it with the MSCI World Index, that's got about 60-70% of US stocks at some point in time. And you also have the S&P 500, which is the brown line, and the S&P net return. The net return means that the dividends are reinvested, but after accounting for withholding tax. So I could not find the net return for a longer history. So the white line is the net return. It's a very short history is only available, and you can see here that the green line is the EAFE index. The green line has underperformed the world index, which is the pink line, and underperformed the S&P 500 since the late 90s. It is only in the the mid 1980s and early 1990s that the EAFE index has outperformed the world index. I mean, how many people would be interested in investing in such an index in the name of international diversification? I mean, it's bizarre. I don't think. See, the true diversification means your returns will be lesser than some other index which at any given point of time has outperformed. So most investors are not ready for that, and I don't think this fund is going to be that popular, and except for few people who I see who say I want geographic diversification and so on. I don't know how many of them understand what they are actually in for, and I think there's really no need for that. if you look at the S&P 500, the same AMC has an S&P 500 index. If you look at the S&P 500 fact sheet, the brochure and so on, the AMC there says 40% of the sales of S&P 500 comes from foreign countries. So it's a significant revenue of the S&P 500 is from is well diversified. They get in revenue from all over the world. So if you invest in the S&P 500, already you have global diversification to a large extent. And there is no ideal way to get international diversification even today for Indian investors. This is my feeling. The problem is, if you choose Nasdaq 100 and S&P 500, you get significant tracking errors. If you choose a fund like Parag Parikh or Axis, Axis Global Opportunities, whatever, that kind of fund, then there is a risk of the fund underperforming because it's an actively managed fund. So there is really no ideal way to do it. What people say is that, look, I don't care about the tracking error. If I get 20% return, how does it matter when if there is 5% tracking error or 4% tracking error, is the kind of argument that many investors have made. But my contention is that is only one aspect of it. If you want it to be truly part of your portfolio, then you should rebalance it properly, you should maintain it. That also many investors are not ready for. So if you are not ready for all that, then you choose something like Parag Parikh or Axis Global Opportunities or whatever. If you truly want, if you're truly capable of maintaining a portfolio and want international diversification, then you can choose S&P 500. That's what I would recommend as of now. But there's another thing you should understand if you are going to chase returns, which is what most people do. I have recently compared S&P 500 with the Sensex. You can have a look at that video and you understand what to expect over the long term. I'm not saying don't invest in that. Don't invest in outside India. But if you are going to invest, you must be ready for both the good and bad. So obviously, our recommendation for the EAFE top 100 is to avoid it.